is Ed Jorgensen, and welcome to our end of the first half outlook, China, Trump, and the politics of 2020. The U.S. stock market has traded back and forth in a range since early 2018. That's about 18 months. There have been some wild rallies, wilder sell-offs. Right now, we are back at the top of the trading range. Obviously, there are risks, and we're all talking about it. There's the standoff between Trump and China over trade, which goes far beyond trade. It goes beyond the role of China and the West as China emerges as an equal power to the developed economies of Europe and the United States, equal economically and increasingly equal militarily. And then just recently, Iran responded to our oil embargo by what looks like provocations attempting to ignite some sort of regional, if not conflict, at least a regional incident that might entrap the U.S. in a war and rally the Iranian population around the increasingly unpopular mullahs. Where Iran heads, nobody knows, but after 50 years of engagement in the Middle East with multiple embargoes and multiple wars, I don't think any of us have anything good to say or much hope for a decent resolution. And of course, in the US, we have our own election season, which is increasingly a farce. I won't even go there. It's obvious. Among pundits, as the U.S. economy slows down, Democratic pundits like Paul Krugman have doubled down on their forecasts, now 2 years old, that Mr. Trump's economy would collapse. Hasn't happened so far, as the Dow's added thousands of points, but risks increase and periodic recessions are normal, so I think Mr. Krugman now is going to have a voice, and increasingly markets are going to listen. Will there be a major recession in the Western world? Is there one going on right now? Let's look at the business world. Copper is a great indicator of the economy. Copper is used in all construction. And copper prices did fall in late 2018, early 2019, but they've recovered slightly. They're well above the lows of 2016. But they do indicate a flat economy. Junk bonds, which measured the risk of highly leveraged, somewhat speculative, tenuous industries, show rising yields, so borrowers are worried that there could be defaults in lower tier businesses in a recessionary economy. But the junk bond yields are well below the peaks of 2016. So again, we have an indicator of risk, but not an indicator that we are in the middle of a major recession right now. For international trade, we can look at, for example, exports out of Korea and the Asian Rim. Those exports certainly fell in late 2018, 2019. Undoubtedly a reaction to the sanctions that Mr. Trump imposed on China. But Korean exports are still above the lows of 2016, the most recent semi-recession lows. A little stronger recently. Again, a flat world economy, but not a collapsing world economy. Same story out of shipping rates. Ocean-going shipping that carries commodities called dry bulk shipping. Rates certainly collapsed in early 2019 as the Asian trade stalled, but have recovered recently. Rates are above the lows of the 2016 international slowdown, below the levels of 2017, 2018 highs. Again, confirming that we're in a flat period for world business and world trade. Exactly what markets and common sense are telling us. Personally, I think the saving grace for the Western economy in the midst of this trade turmoil is low oil prices. I think you know I'm a believer that oil is underestimated as a factor that controls the Western economy. I view that oil is, or energy, is literally the fuel of factories. And when energy prices are abnormally high, as they were in 2007 before the world financial panic, we are at risk. And the reality is that energy prices today have fallen back as the economy slowed worldwide, and are half what they were at the dangerous peaks of 2007. And today's lower oil prices are preventing the world economy from slipping into a more severe recession. You know, I have a program that estimates where I think the current consensus of artificial intelligence program trading is working the market. Right now, to me, we are at the high end of the program trading that I would expect to see. The lower end is around Dow 25,000. We broke through the lower end in late December of last year, and that the programs piled into the market, and it scared the Federal Reserve Board into halting their rising interest rate policy, and indeed shifting to easier money here in 2019. When we had the sell-off in April, we came down to that Dow 25,000 trading range level, and I would find that a normal, typical trading risk. So we'll see. If interest rates go lower and oil stays low, my guess is we'll work our way out of the recession and slowly back and forth in this trading range, but not a devastating collapse such as some are expecting. Maybe the biggest support to this market right now is that the sell-off in late 2018 wiped out about 15% of the speculative margin debt that was in the market. And that margin debt represented a risk that's been taken out of the market. Margin traders are still liquidating, so there isn't speculative money coming back into investment markets that would push prices up, but much of the selling may already have happened. So where are we? We're in the middle of a worldwide mild recession, a slowdown, but probably not a recession here in the United States. Investments are priced for optimism. They're at the higher end of the range one might expect. But with any luck, the slowdown will be contained. It sure helps that oil prices stay low, and it sure helps that we stay out of war. All bets are off if we start having a shooting war in the Middle East. all bets are off for any number of reasons, not least of which oil over $100 a barrel would completely smash this economy and this market. So we have risks. Right now, caution, but not panic, would be my suggestion. Of course, the U.S. political season guarantees that commentators and politicians will be exaggerating, and those supporting Mr. Trump will be saying everything's great. Those opposing him will say that we're on the edge of doom. We're probably in the middle. Calm and cautious would be a good idea right now, and I think you all sense that. So there we are at mid-year. The returns have been surprisingly good this year, and let's hope we stay out of war and keep low oil prices and slowly work through the worldwide mini recession and the slowdown that's currently going on in the US. So I look forward to talking to each of you individually. And as the summer begins, fun to all. I'll be in touch. Bye-bye now.